Hello and welcome to Policy Watch, your packed snapshot of the week's biggest business stories, their context, their relevance and policy impact. I'm Govindraj, Ethiraj. The Union Budget 2017 will be presented next week by Finance Minister Arun Jaitley, and all eyes are on the tax proposals that could be part of this annual exercise. Now, there are two broad sets of expectations. The first is an increase in the tax slab for individuals and a lowering of tax rates on businesses in keeping with the timeline announced already by the Finance Minister in the previous budget. Now, the second is the building block for the goods and service tax, or GST. Now, it is widely expected that service tax rates might rise, while some other taxes on goods, for instance, might come down as the government aligns taxes for a July launch. Now, having said that, what are the biggest factors that will be at play or should be at play in the budget 2017 when it comes to taxes? To discuss this, I'm joined by Abhishek Rastogi, partner Indirect Tax at Khaitan and Company, and Vishal Shah, partner at PwC. Thank you both for joining me. Vishal, let me begin with you. So, what we're trying to understand is what are the expectations, the immediate needs from this budget, and what may be the likely outcome?
Okay, so three broad themes that I would say in terms of the expectations that the industry and the citizens in general are looking from the budget. One is pent up the demand because that's been really one of the areas where people have been struggling in the last 2 months, especially because of the efforts taken on demonetization.
That could be addressed by a tax response? Or?
That could be also done by a tax response. The second is giving fillip to investments, because that's the other way to pick up growth. And the third is the ease of doing business. I think all three have been sort of existed for several years in that sense now. But maybe the degree or expectations this time is a bit higher because of what has happened in the last 2 or 3 months. And what we see India playing a bigger role in the world economy and the global world stage. So just how do we use tax as a mechanism to achieve some of these three objectives? I mean, you very well touched upon the issue on rate. Leaving more with corporates, leaving more with individuals is a policy of less government and hopefully leaving the money in the right hands. The productivity of that investments is likely to be much higher as compared to those that we have seen in the past being done.
So this you're saying is the philosophy that should be driving whatever comes out actually in the budget. Okay, exactly. Now we'll get down to one or two specifics in a moment. So let me come to you, Abhishek. What's your sense now? I mean, I know we've touched upon this in the past, but as we go in, what should the driving philosophy be, which of course converts into specific action?
I think the government will very much focus on the key economic reforms which are going globally. And if you see the global economic turndown, that will be some decision making for this government, and I'll come to those customs rate where they would want to have that impact. The second is this trans-Pacific partnership, and we know that the US has gone away from this, and this entire partnership will be in doldrums. So I think now is the right time for the government to focus on certain sectors such as textiles, and we know that textiles and yarn production from India and the exports has been suffering. So I think this is the best time when they will analyze these global slowdowns, because there are a couple of products which are getting dumped into India. So will there be an excess customs duty on that? Will there be some anti-dumping duties imposed? And at the same time, I mean, critical sectors like textiles, where I think the government, this is the time.
And that's an important and current point, because this is not something we could have prepared for pre-Trump.
Yes.
And it's really developments of the last 1 week or so that we are actually now recognizing and saying, can we align or realign ourselves?
Yeah, exactly. And that's why I think this last week, from the last week and this week, the government will have to do a lot of brainstorming, because while it may not have been in the agenda, but now is the right time to boost certain of these sectors, and especially when we want to focus on Make in India. So I think from that perspective, it will be a very important budget.
And you said textiles is one illustration of how this can be done, because it's clearly a global product that's being served. Okay, let me come back to you. So you talked about demand, right? And can tax be a tool to help drive that or resurrect that? How could we do that?
So I mean, the one and the most important is tax rates. For example, if you leave more with the people, the more likely that they will spend in the areas of their consumption, their demand, etc. Of course, you've had several measures in terms of the pay commission and the other efforts which have been used to pick up the demand, but tax could be an innovative way. The other thing is on driving investments. If you incentivize investments in insurance, if you were to incentivize investments in pension, etc., you will see that investments will get driven that way. With fixed deposit rates now coming down, you need alternative means for people to invest, take care of their retirements and so on and so forth. So I think to drive that right behavior into the right investments, tax could be a very effective tool. It's been always used in several years. I mean, you've seen Section 80C give insurance policies, special deduction, infrastructure bonds,
would that sort of run counter to the trend in the past? We've actually been trying to reduce all these incentives, and now you're saying that...
Yeah, so the reduction on the incentives should be done to more from a corporate tax perspective.
Okay.
So, let me just touch a bit on this point on the tax rate on the corporate sector. Look at the world over. UK already has a tax rate of 20%. The US has been having this heavy talk on saying how do we remove the 35% tax rate and slash it to almost 15%. With India at 33% and the advanced economies, developed economies at around 15 or 20%, do you expect investments to come into India? So if you really have to give that fillip to investment, isn't tax rate therefore a good tool? Now, there could be a race down to the bottom in the world because everybody will want to go towards that race, and then nobody gains ultimately because everybody is still the same.
Right.
But we still need to be in line with the world as such. So while the finance minister has already announced that he wants to reduce it to 30% by 2020, maybe that might need a bit of acceleration.
So you're saying effectively there are two reasons why we should be looking at tax. One is the internal, which is because of spurring demand, and second is alignment with global rates. And that is more for corporates. Okay, I'll come back to this. So textiles is one example you quoted. Can you build on that a little bit?
Yes, of course. I think if you see the wind power energy, definitely the excise benefit has to go to this sector because it has to be treated at par with the solar energy. So I think this is another example, and I think the government will focus and make some of these fundamental changes. Similarly, again, if you see the customs, if you import drawings in the hard copy form or you import it in the soft version, the taxes are different. So there are certain anomalies even in customs, and I think this will be very relevant for the government to track it now.
Right.
And especially when we are moving towards GST, the customs remain as it is. So while there are certain import of services which are getting taxed, not only in the service tax, but are also included in the valuation for customs purposes.
Right. So we've touched upon this on Policy Watch a couple of weeks ago, but what's your sense of GST deadline? I mean, are you comfortable with July as a date?
I think yes, July 1 looks a very reasonable deadline. The industry is geared up. A lot of associations have done that brainstorming. Looks very feasible date, and I think everybody is mentally prepared. So there'll be key announcements with respect to this change as well. And when I say that, I would want to refer to the central sales tax rate, which has to basically go down because it gets ultimately subsumed in GST. So I think this budget will make some key announcements with respect to central sales tax rate and other customs rate.
So the alignment that we've talked about. So Vishal, you talked about a couple of other things as well, which are important from a tax approach. One was to do with demand and everything connected with it. What are the other?
I think the other major focus will be how to drive investments. One is foreign investments. India still relies heavily on foreign investment to make things happen within the economy. We have two important issues to address there. One is India is bringing in the GAR or the General Anti-Avoidance Regulations from April 1, 2017. We don't have adequate clarity until now as to how the GAR provisions will apply. And I think with all the efforts that the government has taken in the last 2 or 3 years to sort of simplify, clarify, and several efforts have been taken. I think it's well lauded by most of the investors as well. They are seeing the intent of the government to be clear and upfront and certain about things. I think bringing in a GAR without any clarity on how the tax authorities would want to apply it would sort of really be a downturn in a sort of not the right direction in that sense, given the past trend. So that's one thing in terms of the GAR. And the other is the global project on base erosion and profit shifting, which the OECD and the G20 are working towards and saying that
can you explain that in
simple, the world over, the governments are concerned that multinational enterprises operating in emerging economies use innovative tax planning opportunities to move their profits away into low tax jurisdictions, and therefore the effective tax that the country should get for the activities that takes place within its jurisdiction are not
And this could apply to big companies as well.
This applies to all the big companies. In fact, some expectation that there and some empirical studies that they've worked out that the tax profits or the profitability in the low tax jurisdictions of these affiliates is almost 3 times the profits that they report in the high tax jurisdictions, which shows that they are sort of moving or shifting profits.
So what's India's role here?
So India has been an active participant in this whole program over the last 2 years. The OECD and the G20 have completed their studies on what all are the ways to bring it. So, for example, how do we avoid treaty shopping? How do you avoid sort of a conduit or sham transactions? On variety of things, whether it's debt, IP relocation, the intangible property relocation, etc. So those are some of the areas where a lot of action has happened. I think one of the things where India has not been able to clarify is what is its position on some of these things. While this is a global initiative, much like the general agreement on trade and tariff for indirect tax, this is like a global initiative for corporate tax, on transfer pricing included with that. But I think the key is for India to clarify where it stands on some of these things, because that will be sort of driving some of these investments in the future. So I think BEPS and GAR are the 2 areas which we need to address.
We're running out of time. So last question that I'm going to put to both of you. So first, one of the issues with most budgets and the tax proposals that emerged thereof is tax administration, and what has been done or is being done on a continuous basis to make administration easy, make life simpler for the taxpayer. Any specific expectations there?
I think there has been a huge work done in terms of the tax administration reforms. How should a new law be brought in? How should current issues be clarified in the law? And multiple things. How the internal workings of the department is. I think there's enough material out there for people to act upon. A lot of steps have been taken. I think it's very well lauded in the last 2 years. But if we can just take that process forward in terms of the tax administration reforms, there are 4 different reports on different areas of it, which once they are addressed, I think that will bring in a lot more maturity.
Any one area that you feel needs urgent attention?
I think one immediate area is getting in this certainty element in any new law that comes in. So whenever you new law, like a GAR we spoke about, whenever you bring in a new law, you bring in with adequate clarifications and guidelines so that the tax administration is also aware as to how do you operate this. And the other related part to it is to say that whenever you are bringing in a new law, also have an effective dispute resolution mechanism, because you don't want things to linger on for years and frustrate people.
Right. Abhishek, last word quickly.
As far as the indirect taxes are concerned, there are about 100,000 matters pending in the tribunals. So definitely there is a need to have more tribunals and above that more tribunal members, so that these matters get resolved before the GST is kicked in. Another important point which we should not ignore in this budget is with respect to services, because while these services contribute significantly to the GDP, there are a lot of ambiguities which are still there. So whether it is bad debts, liquidated damages, and so on and so forth, I can talk about these. Sure. These have to be addressed in this budget before we go into the GST mode.
Well, we've run out of time. Stay with us as we find out what India's financial markets want from Budget 2017. That's coming up with Prakash Diwan of Altamount Capital and Sushil Choksey of Indus Equity Advisors. Welcome back to Policy Watch. Indian stock markets are now recovering strongly from the demonetization scare. During the week, both the Sensex and Nifty hit 3-month highs, their highest since November 1st, largely on the back of strong quarterly earnings, particularly finance companies. Now, the question ahead is, what are the signals the markets are sending out for the Union Budget 2017 coming up next week? Will domestic or global factors play a bigger role? And what are the factors that will most likely affect the markets, and more importantly, the underlying companies that are listed on the bourses? To discuss this, I'm joined by Prakash Diwan, Director at Altamount Capital Management, and Sushil Choksey, Director at Indus Equity Advisors. Thank you both for joining me. Sushil, let me begin with you. So as we go in, I mean, we've obviously seen the markets recovering. Demonetization fears seem to have receded, or not?
Yeah, they've receded to a great extent. First, thanks for having me on the show. Yeah. They've receded to a great extent, keeping in mind that the good results have been reported. The companies which will have some impact or likely to be vulnerable to demonetization will be reporting more or less now in next fortnight.
Okay.
So one should not say there was no impact. My personal take is that unorganized sector has taken a big hit. Organized guys have taken a larger benefit, and rather they will be more beneficial going forward.
Right. So informal economy has been affected more than the formal economy, right? That's one takeaway from this. Prakash, what's your sense?
So, Govind, essentially the demonetization scare had lowered expectations a lot. So if you see, in light of that, the results seem pretty okay. But if you were to take demonetization out of the picture and evaluate results on a Q-on-Q basis, there's nothing much that's dramatically improved. So my sense is this whole expectation of demonetization being a drag or a stressful incident in the short term, while it was beneficial in the long term, was just conjecture. Nobody knows actually what impact you're going to have of this. So it's a black box. You have to wait for 2-3 quarters. Absolutely. So my sense is, in light of that, the market's really woken up to this whole thing, saying, hey, it's not so bad, and then life's back to normal. But going
what is the normal is the question. I think.
Yeah, exactly. Is the normal really interestingly different or better? I would believe it will still take a couple of quarters, and it has to be preceded by capex from the government. There's no pump priming that's yet happened. Now that the government is probably seeming to be in a good deficit position of sorts, you could probably have post-March some sort of stimulus that could drive things, and then capex from the private sector will follow, and then the numbers and earnings will, and the market is slave to earnings. So I don't think this is something which is too euphoric of sorts. The earnings are okay, it's a mixed bag yet, but and essentially the first half of the earnings is always good companies, better companies. So let's wait
for the second half. Absolutely. So Sushil, there have been a couple of clouds on the stock markets, right? The likelihood of some taxes being imposed, the likelihoods of some way of extracting more from sale of the capital that's earned, capital gains on sale of shares, for instance. Is that concern still there, or?
I think the debate between what was said by Mr. Prime Minister Narendra Modi and Arun Jaitley declined. I mean, he made it negative compared to what he said. My personal fear was there when Narendra Modi made a statement. So they may tinker around, but they know the damage which will happen if long term, at least on a short term basis when it's announced. But looking into various aspects right now, I think they're more in damage control mode because of demonetization to some extent. So I don't think so there is a likelihood step like that. But more than that, if you want, what are we going to achieve by imposing tax on long term? You may shift from 1 year to 2 year or 3 year, depending. Or you may increase STT, because that is a better way to collect tax rather than escaping. So I think the entire thought process on long term might have got initiated because of these penny stocks, which are creating a lot of havoc. And if you ask in market circles specifically, this penny stock, which outside Bombay is more a trading happening for conversion of cash. I think those are the challenges which government needs to manage well along with SEBI, rather than capital formation, which is a necessity for growth with no private capex.
Right.
And public sector, we need to be efficient. At the same time, the RBI is clearly saying that corporates have to go to bond market and not depend on banks. We need long-term capital, and we need to be right and prudent and not doing something with damage.
So as a theme, then that sort of gives us one strong theme to go ahead, saying that one thing financial markets clearly expect is the preconditions for creation of real capital, which in turn fixes or hopefully will fix the problem of capital formation.
That's right.
In this country. Prakash, what else would you want? Is there any sort of fundamental theme going in?
Yeah, I think it's the first round of the government milking its own assets, which you very clearly seeing the kind of dividend payouts that we've just, a spate of high dividend payouts that we've seen and being announced. My sense is this year, calendar 2017, is also going to be a very promising year in terms of IPOs, new offerings, new paper getting added to the market. And we've seen the kind of response that even a BSE IPO has got. So
you're saying that your expectation was that it would not have got such a response?
I mean, given the growth triggers and the growth dynamics, it's just an average piece of paper, but it's a scarcity of good paper, and when you have most of the PSU companies, let's say the part of the CPSE 10 stocks, they've already most of them are at 52-week high. So what's next? But you have a whole spate of insurance businesses coming into the market. You have a lot of other government companies that will hit the market. So the government will not do anything which is negative for the capital markets primarily.
Yeah, or on the other side, government should do something positive, because it's got so much of disinvestment lined
money
up,
at stake, so much of potential there, and that will probably be the first leg of change in re-rating of the stock market, and then the private sector will follow. So I think the theme is going to be largely government-backed businesses that will get benefited, whether it's oil and gas, power, infrastructure, housing, wherever the government has some sort of stake in the business, I think those will benefit.
So let's talk about flows. And so there is the global factor and there's the domestic factor. What's your sense on how flows are likely to shape up? And again, can the budget or should the budget play a role there?
See, I'll just take back again, linking to the previous discussion on demonetization. November, December, we haven't seen a penny in reality coming from FIs. It's the domestic mutual fund which has supported the market. What has emerged that domestic mutual funds have started getting more flows. That is the real interest rate which they're earning out of their deposits or fixed income. Now, bond market has given a tremendous amount of appreciation because of yields where they are. How is the domestic saving going to flow to which side? Is it fixed deposit? Is it some new instrument like InvIT or REIT or various other instruments? Or is it going to be equity mutual funds? My understanding is people have started accepting a fact that equity is a necessity to be part of your savings. So whether 5% or 10% or 15%, depending on the age and what your earning pattern is, or you're a fixed income guy, I think people are allocating. So based on current events in US with the indices in US are at lifetime high, and if you even look at today's result, I think the markets are going to be stable. So if the dollar index may be at 100 or 101, but if US markets are going to behave the way they are, you may not have FI inflows to a great extent right now. But if government positions itself with a corporate tax reduction as a single point agenda, because we've already driven interest rates down, we want to make digital economy, and GST is round the corner.
Imminent,
So based on cumulative all these factors put together, earnings will look far superior if you take a 12-month or 18-month outlook. Initial GST shock may be there, but commodity stability along with interest rates are going to drive interest rates, in fact, profits higher, and organized sector is going to get a market share which will be better. Based on these fundamental facts, our EPS number for 18 or 19 will look far superior than what the street is estimating today. And we in India, rather than a Lehman event in 2008 and 2003 when mortgages were available at 8.35 at the lowest to 9% or 9.5%, your commercial paper is below 7 for AAA companies, bond market is at 6.5. Let's say what next can happen? A uniform, a long-term approach, because most important criteria which Modi government needs to attend to is job creation. And if manufacturing doesn't pick up with all these effects, then I think there is an issue which
is a little more fundamental. Okay, but I think granted that many of these macro factors are playing in our favor at this point of time. Let me ask you, Prakash, what's your sense between global and domestic, and your prognosis and Budget 2017's response to it?
Yeah, so let me share what we've kind of found in terms of checking with the FI segment. When post-December, most of them decided to wait for the demonetization effect, if there was any unfavorable impact. Then, of course, the budget's around the corner, and there was this iffy situation whether the budget was on 1st or on 28th. You see, the markets rallied the moment they got this decisive thing saying, okay, finally it's happening on 1st. Now, the next trigger after that, or the milestone, is going to be the UP elections. Of course, the outcome is on 11th March, but the market will start sensing once they have the CM candidate announced, the campaigning, and the first few phases of elections. So the FI segment is definitely not willing to jump in. Wednesday numbers were more of a expiry impact of sorts. I would believe the FIs would wait for the final, outcome of the budget in terms of whether the budget is more long-term in terms of favorable impact, or is it just short-term or tending towards populism.
But all the points that Sushil made, for instance, almost seem to discount the impact of the political economy. Or don't seem to...
it sounds indifferent to the political issue. But having said that, remember the UP elections for the NDA is a ticket to not just 2019, but beyond that as well.
No, yes, that's right. I mean, but the question is, can it affect the markets and too?
It would, because what's going to happen is, the government is right now in a situation where it needs to do some course correction after the negative sentiment that demonetization has done to the image of sorts. But to the the FIs, what's important is consistency and things like the GST, more structural stuff that happens. And if they get the number of seats that UP could lend to them, it becomes easy for those hardcore reforms to finally get into place, which haven't happened. These 2.5 years have been more cosmetic in terms of reforms process. So those structural changes will happen more decisively. So I'm sure the FIs will look at these things.
Okay, so you're saying strong domestic factors will also propel strong international or global flows.
Yes.
Right. So last question, but what's the sense that, I mean, there are things happening around the world which are in some ways beyond our control or beyond our reach. How could that affect markets in the coming year, and should we be better prepared for it in some ways, Sushil?
I think if what has happened yesterday night about Mexico and US, maybe next target is China, we don't know. So if there is deglobalization, a likely scenario in next 6 months, I'm quite sure the world markets will have some impact of it. We are not able to visualize. Does anything happen in European Union post-Brexit? We don't know. So FIs always move along with some global events. But based on last 60 days, my personal take is domestic investors should stick to mutual funds or their advisors, put in money. If GST and corporate tax combine together with low interest rate, I think we will get re-rated and FIs will follow at appropriate time because they'll find India earnings are getting upgraded.
Right. So basically, let's set the pace and then let the others follow. That's a good note to end on. Thank you both for joining me. That's all we have time for on Policy Watch this week. We'll of course be back with special budget programming on Budget Day. Thanks for watching.